Now, as we turn to Europe, it's important to talk about what is happening at the very, very moment, which is Draghi's resignation. So, Italian politics, quoting from Bloomberg, Italian politics are a mess. Italian Prime Minister Mario Draghi's resignation likely puts more pressure on the euro and on the European Central Bank to give more details on its fragmentation tool next week. So when we look at what is facing the euro and the ECB, it's just going to be a matter of how do they try to stabilize. And the problem remains they've maintained an easing stance for so long that they are essentially captive to their own policies, and rates are already moving parabolic. Italy is their debt is being dumped, so rates are going through the roof. But is this fragmentation? And again, we went through a deep dive on what is fragmentation. How do you define fragmentation? And this is Lagarde is going to provide more color on that next week to understand. Well, are they going to step in on Italy? Is this deemed fragmentation, or is this just local local politics that has no significance for? Obviously it's going to be significant for the euro and the European area, but it doesn't require support from the ECB, and that's going to be the pivot. Now, as we were saying before, and I had some good questions on Twitter, somebody said, how far do you below do you think the dollar goes? The euro goes below the dollar. So I said that I think there could be a break to 0.98. The problem is you're going to have a lot of central bank activity to try to keep this around parity. And so I think that you're going to be fairly capped in terms of what kind of movement you get. And I think that's going to take some time to filter through. But this obviously Draghi, this resignation, the 5-star battle is not going to be a good thing for the euro in the long term. It's just going to create more headwinds and more uncertainty outside of the fact that you still have inflation going up. You still have an issue with Russia and Ukraine. You still have a lot of these problems, and this is only going to make it worse. So when you look at the Eurozone aggregate, the survey expectations last month, it was negative 28 instead, and it came in at negative 51.1. So again, things are getting a bit worse. Industrial production in May was better than expected, but as we said, we expect June and July to continue on the downward trajectory. When you look at Germany, the industrial production for May was 0.2, expected to 0.4. But the ZEW survey, which I think is important because it's more real time, expectations were for negative 40.5, came in at negative 53.8. Current situation was expected at negative 34.5, came in at negative 45.8. So again, you're seeing the concern as all of these issues arise. And as we talked about last week and the last few weeks, wages haven't kept pace. So in the U.S., you've had wages go up. They've started to come down. They've started to peter out. But wages never really reacted the same way. They went up, but not to the degree they should have, which just means that real wages, real spending, or I should say real available cash is much worse than before. And now when you start looking at the dollar, with so many things being priced in dollars, the euro had an advantage. You were, gaining anywhere from 10 to 15 cents against the dollar. That's now gone, and now you start to get some of this friction, especially when you start looking at the export side. Now, when the price of the currency comes down, you typically see exports increase because now it's more advantageous, it's more cost effective for someone like in the U.S. to go buy something, because instead of it being $1.10, it's now just $1. So you're like, oh, well, it's 10 cents cheaper in theory than it once was, which again could create a bit more of a tailwind on the export side. But obviously there's other pressures that are weighing in on that. So CPI came in right in line with expectations, again, staying at the highs. Wholesale prices, month over month, came in at 0.1. The index year over year, 21.2, still massive elevated levels that were going to remain. So recession probability. So when you look at before the Russia-Ukraine war, it was at 20%. The June survey was at 30, but now the July survey is in Germany at 55% and in the euro at 45%. And again, these are things that I think are obviously going to continue to move up because I do believe that is already a recession. So Draghi, the anti-fragmentation tool, was always going to stand on shaky foundation, and relatively quiet Italian politics was a prerequisite for it to work. Clearly, that is not the case with Italy's government break as a coalition ally set to quit. Draghi, who had said he was going to resign and did, if the five-star walked out, and obviously they have walked out, which again is creating more of that downward pressure. So the Eurozone debt as of Q4 2021, you can see that it still remains very elevated, with France staying at a very high level, with a large part of that still being non-financial corporations, households in general. When you look at it in France, Belgium, Finland, Greece obviously still has those issues that never went away and have always been just beneath the surface in general in terms of where things are and how things are going. And now this just in, Italian President Sergio Mattarella rejected a resignation offer from Prime Minister Mario Draghi. So things just continue to get worse, and the Italian president may push him to go out and try to form a coalition to try to keep things stable. So there's going to be a lot of political jawboning back and forth, at least over the next few days. But the debt situation, as you can see here, never improved. I mean, when you look back to the financial crisis, the European crisis in 2011, nothing has changed. We just kicked the can, and now here we are. And if you look at just Italian debt, Greek debt, that is why the Italian component to all of this is so important, because there's such a high component of sovereign debt. So what is the risk at this point? And that's why Italy, given what's happening right now, given the anti-fragmentation tool, that becomes an underlying problem. So then when you take that and look at the ECB rate path, we believe that it accelerates. We don't think the ECB has a choice, but they're going to have to go to positive rates. Real rates are still firmly negative. So again, going to positive 25 basis points is irrelevant, but this is where we think that this is just a Bloomberg survey. We just think that it's going to move at a bit faster clip higher. Eurozone trade deficit blows out. So here you can see the trade deficit actually went negative. This is the first time, as you can see, going back all the way through in a long time. So with the U.S., Russia, China, so the trade deficit, so Eurozone trade balance, there's also a certain amount of timing with it. So the question is, what is the timing going to look like? We think this will come back up a bit, but there's going to be a struggle. And the problem with this and what is driving this right now, the Eurozone has to go out and buy more expensive LNG instead of getting piped natural gas, more expensive oil, more expensive diesel. So the inputs are just going up, which is, again, blowing this out because they're increasing imports exponentially, especially on the LNG side, and that's just at a much higher price. So then when you start looking at, German CPI food, which is keeping us, obviously, CPI food is at 12.7%. This is just the food side. And that's why when you look at the US, you look at Europe, we don't see food inflation stopping. It continues to be broad-based. It continues to be a problem. And that is not something that is going away anytime soon. So the German expectation of economic growth, you can see it's the lowest it's been since 2011. When the financial crisis started, which is why this is only going to make things worse and not getting much better, with investor sentiment sinking. So when you look at normalized index of ZEW and Zentech, Eurozone Composite PMI, it's why we already think we're in a recession. We think that the move down is there, and you're going to come into a contraction on the composite PMI either this month or next month, just given the timing and some of the lag. But again, we already see a lot of that slowdown. So France, the current account balance negative, CPI slightly higher than expected, but again, fairly stable in general. Industrial production in Italy, slightly better than expected, but still negative. And this is going to put a damper on that because if you look at all the data, it's in May. And so when you look at June, July, you're seeing this downward pressure. And again, why we see so many issues. But the ECB meeting is going to be so important next week because we're going to have to get some clarity. And I think they will try to support the euro. They are going to raise rates. And I think the anti-fragmentation laws or rules, if you will, are going to be very important. And hopefully they don't overstep and let the market be the market. But we all know that central banks and governments like to let the market do its thing and balance out and find an equilibrium more and more. Instead, they like to increase influence, increase their manipulation, which then maximizes and just compounds the knock-on effects. So then when we start looking at France trade balance, you get an idea of just how low it is in regards to where it is. And a lot of this is, again, driven based on the importing of energy, which is going to remain very elevated. And the same with Germany. When you look at what is the inputs, energy is obviously a high one. Food remains an elevated one. Services, all of these, it was pretty much across the board. You're continuing to see these increases. Energy is going to slow down a bit, but you're getting an idea. A slowdown is still at record levels. So we're not slowing to, we're going into deflation. Again, slowing rate of change. But you're still seeing the consumer under stress. You're still seeing these pressure points. They're feeling worse and worse about the situation. And this is why we do think things continue to get a bit worse in the European theater. And again, confirm that recessionary view. So that's what we have for you on Europe. We'll have more as the ECB comes out with their updates next week. Unfortunately, I'm going to be traveling for work. I'm going to be visiting a bunch of different dams. So we won't have the Econ show and EIA show next week. But again, we'll bring it all back together the following week. So that's what we have for you on Europe. Next segment is now Asia.